Imagine a tech giant that acts, well, less like your typical Silicon Valley innovator
Mhm.
and maybe more like a private equity firm, just snapping up essential tech assets and then relentlessly optimizing them for profit. That's pretty much the story of Broadcom. Welcome to the deep dive. Today we're peeling back the layers on Broadcom Inc., ticker AVGO. It's a really fascinating, sometimes controversial tech behemoth. We've got a ton of research here looking at its two main engines, semiconductors and infrastructure software. We'll look at its key role in AI and the cloud, and of course, that huge game-changing VMware acquisition. Our mission really is to pull out the most crucial bits of info so you can truly get what makes Broadcom tick. Its strengths and, yeah, its big risks too. We'll dig into the mind behind it all, CEO Hock Tan. His playbook is, well, unique. It's made Broadcom a powerhouse, no doubt, but it's also stirred up a lot of friction. So get ready for maybe some aha moments as we look at a company where cash flow seems to be king. Let's unpack this.
Yeah, what's really striking about Broadcom is that it's less about inventing the next big thing from scratch and much more about buying companies that are already leaders and then just squeezing maximum financial value out of them. It's very deliberate.
Absolutely. Less build it and they will come, much more buy it than optimize the heck out of it.
Mhm.
And to really get this, you have to start with the architect, right? Broadcom's president and CEO, Hock Tan. He's not the usual Silicon Valley product guy, is he?
Not at all. Think of him more as a master strategist. Background in finance, operations. He's laser focused on financial discipline, shareholder value. That's his North Star.
Okay, so this M&A playbook, how does it actually work?
It's consistent and very effective. People often compare it to a private equity fund, but inside a public company. Step 1, identify category leaders. Companies with dominant mission-critical tech. Stuff that's really baked into how customers operate.
Right, so high switching costs. Makes sense.
Exactly. High switching costs, predictable revenue.
Right.
Think about the names: LSI, Brocade, CA Technology, Symantec.
And the big one, VMware. These aren't small players.
Definitely not. They're foundational.
Right.
Then comes the integration. And it's aggressive. Post-acquisition, they move fast, divest anything non-core/costs.
Yeah.
Really strict controls.
Brutal efficiency, is that fair?
I think that captures it. The goal is to align the acquired company with Broadcom's own high-margin model. Make it lean.
And the ultimate aim of all this efficiency.
Cash flow. Turning these acquisitions into cash-generating machines. Pure and simple. That cash then pays down the debt from the deal. It funds dividends, buybacks, and it fuels the next acquisition.
It's a cycle. Buy, optimize, generate cash, repeat.
Precisely. A self-reinforcing cycle built for financial strength.
Yeah.
And that financial focus, that discipline,
Yeah.
it's core to their whole identity. We'll definitely circle back to that when we look at the numbers.
Okay, good point. So speaking of identity, let's talk about these two growth engines, semiconductors and software. You said it's about 58% semiconductors, 42% infrastructure software for fiscal 24.
Roughly, yeah. Those are the two pillars. And they're getting more connected over time. The semiconductor side is their historical strength. It's really the indispensable backbone of the digital world.
The plumbing, essentially.
Exactly. Networking and connectivity is the crown jewel here. They dominate Ethernet switching and routing, Silicon think Tomahawk, Jericho chips for data centers.
Yeah.
And also fiber channel networking from the Brocade acquisition for storage networks.
In AI, this is where it gets really interesting for semis now, right?
Oh, absolutely. AI infrastructure is the huge growth driver. These massive AI models, they need incredibly fast, low-latency networking. Broadcom's high-radix Ethernet switches are critical for building out those enormous AI fabrics. You just can't do it without that kind of gear.
And it's not just the networking switches, is it? They're also doing custom chips.
That's right. Custom AI accelerators. They design ASICs, application-specific integrated circuits, sometimes called XPUs. They do this for the hyperscalers, Google's TPUs, for example. Meta's custom silicon.
Yeah.
And there's a big new customer, widely thought to be OpenAI.
So it's like, okay, picks and shovels play for AI. They provide the essential tools.
That's a perfect analogy. They provide the roads, the Ethernet networking that connects everything in an AI data center. And for the biggest players who want something specific, they design the custom race cars, the ASICs. It's a very smart position.
Makes sense. They win either way, whether it's their standard networking or custom stuff. What else falls under semiconductors?
Well, there's wireless. They're a huge supplier to Apple for iPhone parts, FBAR filters, Wi-Fi, Bluetooth chips, and storage solutions too, like RAID controllers and such.
Okay. Let's pivot to that other pillar then, infrastructure software. How did that side get built up?
Mostly through those big acquisitions we mentioned. And now, post the $69 billion deal, VMware is absolutely the centerpiece. The core offering is VMware Cloud Foundation, or VCF. It lets companies build and manage their own private clouds, but with the kind of agility you'd expect from a public cloud, while keeping things secure on-prem.
Which is pretty relevant for AI workloads, right? Keeping sensitive data in-house.
Exactly. It's perfectly positioned for secure AI deployment. And interestingly, they're already working with NVIDIA. They're building an AI-native platform directly on top of VCF.
Ah, so that's the synergy, connecting their hardware expertise with the software platform. Smart. What other software pieces do they have?
There's mainframe software, which came from CA Technologies. That serves a pretty captive audience, big banks, government agencies. Then cybersecurity, mostly from Symantec endpoint and network security. And other enterprise software tools, things like value stream management, AI ops, observability, stuff for running complex IT shops.
Okay. Now, if that M&A playbook sounds intense, the VMware acquisition really put it on full display, didn't it? That caused some major waves.
Oh, absolutely. A strategic reset is putting it mildly. The changes were immediate and radical after the deal closed in November 2023. First big thing, they killed perpetual software licenses. Gone. Moved everyone to subscription only.
Wow, so forcing customers into that recurring revenue model.
Pretty much. No more buying at once. And then the product portfolio. VMware had like over 160 different products. Broadcom just slashed that down to a few core bundles.
Bundles, like
Yeah.
VCF.
Primarily VCF, yeah. And a smaller vSphere Foundation bundle. No more buying individual pieces a la carte style. Simplified things for Broadcom, maybe, but limited customer choice significantly.
And they changed how they sell it too, right?
Drastically. They shifted focus almost entirely to their top, maybe 2,000 or 3,000 global enterprise customers.
Yeah.
And they dramatically cut back the partner program, which had been huge for VMware historically.
Okay, so end perpetual licenses, force bundles, focus only on the biggest fish. I can imagine the reaction.
Yeah, the backlash was immense. You heard reports from customers facing staggering price hikes. Some quotes were apparently 10, even 15 times higher than their old contracts, especially if they only used, say, standalone vSphere before.
Ouch. That must have opened the door wide open for competitors.
It certainly did. Companies like Nutanix, open source options, they saw a huge opportunity. Lots of small and mid-sized businesses, nonprofits, even some larger companies started looking very seriously at migrating away.
But this churn, it sounds like Broadcom almost expected it, or maybe even planned for it.
It really appears to be a calculated consequence.
Yeah.
For VMware's largest, most deeply entrenched customers, the Global 2000, migrating that core infrastructure is a massive undertaking. Years of work, huge cost, lots of risk.
So the bet is that those big customers are essentially captive.
That seems to be the calculation. They're focused on maximizing profitability from that core, sticky customer base. They seem willing to let the smaller, less profitable customers churn if it means higher margins from the ones who stay. It's a trade-off.
A very clear, if somewhat harsh, strategy. Okay, let's broaden the view of the market landscape. The numbers here are just huge.
They really are. The overall semiconductor market, it's heading towards, what, $2 trillion maybe by the early 2030s?
Mm-hmm.
And within that, AI accelerators. That's the explosion. Maybe $125 billion just this year, 2024, could hit $500 billion by 2028.
$500 billion just for AI chips. Wow.
It's staggering. And infrastructure software, while not quite that explosive, is still a massive growing market, projected $210 to maybe $426 billion by 2030, 2034.
Okay, massive opportunities. Now, in semiconductors, let's talk NVIDIA. They're the 800-pound gorilla in AI GPUs. How does Broadcom fit in?
It's a fascinating dynamic, often called co-opetition. They compete and cooperate. Broadcom provides that essential high-speed Ethernet fabric that connects all those NVIDIA GPUs together, so they enable NVIDIA's success.
But they also make those custom ASICs.
Exactly. For the hyperscalers like Google or Meta who want an alternative to NVIDIA's full stack, or just something tailored. So Broadcom provides an alternative path for the biggest buyers, competing directly in that sense.
Okay. Who else are they battling in the semiconductor space?
Well, there's AMD, obviously. They compete hard in GPUs and CPUs. Intel, still the giant in CPUs, and pushing into accelerators too. And Marvell Technology. They're probably Broadcom's most direct competitor across networking silicon, storage, and custom ASICs.
Right. Now, shifting to software and cloud, it's complex because their customers are also competitors, yeah.
That's a key point. The big public cloud providers, AWS, Azure, Google Cloud, they buy tons of Broadcom's networking and AI silica. Huge customers.
Ugh.
Broadcom's VMware business is pushing the private and hybrid cloud model, which directly competes with the public clouds for enterprise workloads.
So they sell to them and compete with them. Tricky. And the VMware changes definitely energize the alternatives, like you said.
For sure. Nutanix is making a big play for disgruntled VMware users. Red Hat under IBM has OpenShift and KVM-based virtualization. Plus, you still have the traditional enterprise giants, IBM and mainframe software, where Broadcom via CA competes. And Oracle also pushing hard into cloud and AI now.
Okay, complex landscape. So let's get to the bottom line, the money machine. How does this strategy translate financially? You mentioned profitability.
Engineered for profitability is the phrase. They're non-GAAP gross margins, consistently over 75%, adjusted EBITDA margins, regularly north of 60%. That's just incredible efficiency. We saw that record revenue in Q3 fiscal 25, nearly $16 billion, up 22% year over year. Big boost from AI silicon and the VMware integration starting to really show.
But the number that really jumps out from our sources is the free cash flow, the FCF.
Oh, yeah. That's the metric that truly shows Broadcom's economic power. They are an absolute cash machine. FCF went from, what, $11.6 billion in fiscal 20 up to $19.4 billion in fiscal 24. Then in Q3 fiscal 25 alone, they generated $7 billion. Just astonishing.
And projections are even higher now with VMware fully in the mix.
That's right. The projections are pushing towards $30 billion for fiscal 2025. And looking out maybe 5 years, some see it exceeding $50 billion annually.
$50 billion in free cash flow a year. That's hard to wrap your head around. And you mentioned before, this is different from their reported net income.
It is, and it's a crucial point for anyone analyzing them. GAAP net income often looks lower because of massive non-cash charges, specifically amortization of intangible assets from all those acquisitions. Over $8.4 billion in FY24 alone. That hits GAAP income, but it's not cash leaving the building. So FCF gives you a much clearer picture of the actual cash being generated. It's the real economic earnings power.
And that cash fuels, well, everything else. Debt pay down, shareholder returns.
Exactly. They use leverage for acquisitions. They had about $68 billion in gross debt after VMware closed, but they paid down fast. Their debt-to-adjusted EBITDA ratio dropped from 3.5x post-VMware down to just 2.1x by the end of FY24. That's rapid deleveraging.
And shareholder returns seem baked into the model, too.
Absolutely. It's a core part of the value proposition.
Yeah.
They've raised the dividend for, I think, 13 straight years now. Significant growth there, too. And they actively buy back shares. They just authorized a new $10 billion repurchase program back in April 2025.
Okay, so financially, it's a powerhouse driven by this disciplined, cash-focused strategy. But that strategy, that Broadcom way, it must shape the internal culture, too, right? What's it like inside?
Well, it's a direct reflection of Hock Tan. Intensely focused, results-oriented, engineered for maximum efficiency. The priority is on engineering excellence, operational discipline, not so much on, flashy perks or a culture of failing fast. It's about execution.
Sounds intense. What do employees say?
Anecdotally, yeah, reports suggest a demanding high-pressure environment, things like you see on Reddit sometimes. And the VMware acquisition, specifically, seems to have caused a major culture clash. Reports of widespread layoffs, friction between the legacy VMware ways and the Broadcom approach.
And this connects back to the customer and partner backlash we talked about, that VMware firestorm.
It does. The abrupt changes, the price hikes, gutting the partner program, it alienated a lot of people. And importantly, this isn't a one-off. You saw similar patterns after the CA Technologies and Symantec deals. So there's this perception out there, especially in the IT community, that Broadcom caters heavily to its biggest accounts and maybe squeezes everyone else. Price gouging is a term you hear.
Okay, so it seems like a recurring theme. Maximize value from the core, even if it causes friction elsewhere. Is the bet that the products are just too essential, too sticky for the big customers to leave?
That really seems to be the implicit wager, yes. That this negative sentiment, while real, is a manageable consequence of their value extraction strategy. The investment thesis essentially relies on that stickiness being strong enough to overcome the friction and retain those high-profit customers.
A bold bet indeed. Okay, let's bring it towards today. Future outlook, investment considerations. What's the view from Wall Street?
Overwhelmingly positive, actually. The analyst consensus is pretty much a strong buy or buy. They're focused on the drivers, accelerating AI revenue, both networking and the custom chips, the VMware integration boosting recurring software profits, and just the sheer strength of their financial model.
What kind of price targets are they putting out?
Average 12-month targets seem to be clustered around, say, $312 to $366. Some bulls are looking higher, maybe $420. Longer term, 5-year base case forecasts are throwing around numbers like $600 plus.
But they must see risks, too.
Oh, sure. The high valuation is definitely one. What if AI spending slows down? The wireless business can be seasonal. And the big one, execution risk. Can they actually retain enough of those core VMware customers long-term despite the backlash? That's key.
And how does retail investor sentiment compare? More mixed.
Yeah, a bit more varied. Lots of praise for Hock Tan, the long-term performance, calling it an AI beast.
Mm.
But there's also a pretty vocal group concerned about the valuation and worried that the VMware backlash could cause real long-term damage, erode the ecosystem.
Okay, so pulling it all together, what's the takeaway for you, the listener, considering Broadcom?
Well, based on our sources, the consensus leans towards a conditional buy,
Mm.
meaning it could be a solid core holding if you're a long-term investor, have a high tolerance for risk, and want that AI infrastructure exposure. You have to appreciate the cash flow focus. But given the premium valuation it often trades at, maybe a prudent approach is to build a position during market dips or pullbacks.
So the thesis really hangs on Hock Tan keeping up the execution, VMware integrating successfully, and Broadcom staying central to this whole AI build-out.
That's the heart of it, yeah.
This has been a really comprehensive look at Broadcom. Quite a company. So, to recap, a unique, powerful force, financial powerhouse built on M&A and that ruthless efficiency. Deeply embedded in AI with both hardware and software. We've seen the incredible free cash flow, the shareholder returns, but also that significant customer friction and the high price tag that comes with the Broadcom way. So, as we finish up, here's something to think about. In this tech world that changes so fast, can a strategy that's mainly about buying and optimizing rather than, say, disruptive R&D and keeping all customers happy really sustain leadership long term? Or does that focus on short-term financial gain eventually start to erode the ecosystem, maybe stifle future innovation? What really stands out to you about how Broadcom creates value?